Welcome to the deep dive. Today, we're tackling something massive, something everyone in crypto is trying to figure out. What's the road ahead for the next big bull run? We're talking 2025, maybe 2026.
Yeah, that timeline feels about right based on the cycles. And look, we've sifted through a ton of research, market analysis, insider notes, really trying to pinpoint not just when, but, what are the actual engines? What's going to power this next wave?
Right. And our mission today is pretty straightforward. We're going to break down 5 specific projects. The sources we looked at are calling them the pillars.
Pillars, yeah.
And these are the ones analysts think have the best shot, strongest fundamentals, real adoption potential, and crucially, the right story, the right narrative going into this next cycle.
And it's that structured approach that's key here. This isn't just throwing darts. The idea is that these five, well, they represent the essential building blocks of Web3. You can't really have a healthy ecosystem without these pieces.
Like what kind of pieces?
Everything from, the base money layer secure, foundational, all the way up to the smart contracts, the data feeds, even the super fast stuff for consumers.
Okay. But before we jump into pillar number 1, let's just set the scene a bit. What's the big picture the sources are painting?
Well, the premise is pretty bold. They're saying the catalysts lining up now think big institutions getting access, this whole tokenization trend. It suggests this next run isn't just a repeat. It could be fundamentally different.
Different how?
Structurally different, maybe creating a whole new wave of capital formation globally. It's a big claim.
Okay. Definitely potent. But let's ground ourselves, like you said.
Absolutely. Got to be crystal clear. We're exploring what the research says, looking at opportunities, identifying patterns. It's about gaining knowledge, understanding the landscape.
Not financial advice.
Definitely not financial advice.
Okay.
Full stop. We're just decoding the analysis that's out there for you.
All right. Pillar 1. Let's start at the beginning. The bedrock. Bitcoin. BTC.
It's still the anchor, right? The sources all seem to agree. It kicks things off and keeps the momentum going. Why is it still numero uno for big money?
Well, the narrative's totally shifted. For the big players, the institutions, Bitcoin isn't some weird tech experiment anymore. It's basically treated as digital gold. That's the mental model now.
Digital gold.
Yeah. It's got the security, the track record, and it's the easiest on-ramp for traditional finance dipping its toes into crypto. If you're managing billions and you look at risk-adjusted returns long-term, Bitcoin feels like the safest first step.
And it has this rhythm, doesn't it? This predictability almost, which is rare here. The sources put a huge weight on the halving event that just happened back in April 2024. Why is that specific event such a reliable trigger?
It's pure supply and demand mechanics, simple but powerful. The halving literally cuts the rate of new Bitcoin creation in half. Boom, overnight.
So less new supply hitting the market. Exactly. The miners get half the reward they used to for validating transactions. Think about it like if suddenly global gold mines could only produce half the gold they did yesterday. Yeah. If demand stays the same or, goes up.
Price has to adjust upwards.
Price has to go up to balance it out. And this happens predictably every 4 years. It's like clockwork. It's arguably the most powerful economic force in crypto, this programmed scarcity.
And the history backs it up. The numbers cited are pretty wild.
They really are. After 2012's halving, something like 8,000% gains. Then 2016, it was around 2,900%. After 2020, maybe 700%.
Okay, so the percentages are getting smaller.
Yeah, they have to, right? Law of large numbers. The market cap is way bigger now.
Yeah.
But the core principle, that enforced scarcity, still the main engine driving the whole cycle.
But this time feels different. There's this huge new factor that wasn't really there in 2020. The ETFs. The U.S. spot Bitcoin ETFs. How does that flood of demand change the equation?
That's the game changer for this cycle. An ETF, especially these spot ones from giants like BlackRock, Fidelity, the names the sources keep mentioning creates this constant, easy, regulated demand.
How so?
Well, when someone buys a share of the ETF, the company has to go out and buy the actual Bitcoin to back it up and hold it. So it's not just speculation, it's real buying pressure day in, day out.
So it's like the supply got cut in half while the biggest players in finance suddenly started buying massive amounts every day.
Exactly. You got the supply shock amplified by this huge ongoing demand shock. It's a potent combination we haven't seen before on this scale.
And the sources are throwing out numbers based on this, right? Potential price targets. I saw $150,000, maybe even $200,000 mentioned.
Yeah, those ranges pop up a lot in the analysis.
But hang on, given those historical gains, even the smaller 700% last time, and now this institutional flood, could those targets actually be kind of conservative? Why aren't they predicting even higher?
That's a really good question. I think the analysis tries to be somewhat grounded, Bitcoin's market cap is already massive. Getting
Uh,
another 10x from here is way harder than it was back in 2012.
sure.
So those over 50K, $200K numbers, they seem based on pretty conservative models of how much wealth institutions might actually allocate. Like if big funds just put 1% or 2% of their assets into these ETFs,
Just a tiny slice.
yeah, a relatively small allocation for them could realistically push the price into that range. It's framed more as a baseline derived from traditional finance logic, not just retail hype.
Makes sense. And Bitcoin's role is bigger than just its own price, right? It sets the stage for everything else.
Totally. It's a
Wow.
liquidity engine. When the big money flows into BTC, it sends a signal. Okay, this whole crypto thing is serious. Then, as Bitcoin maybe cools off a bit after a big run,
People take profits.
exactly, they take some profit, and that capital starts looking for the next thing. Higher risk, potentially higher reward. It cascades outwards
Into the altcoins.
into the altcoins. Ethereum, Solana, the other pillars we're going to talk about. Bitcoin primes the pump, gets the world's attention, and then that liquidity flows downstream and lifts everything else. It's the tide that raises all boats.
Okay, so if Bitcoin is the secure vault, the digital gold, pillar two is Ethereum, ETH. The sources frame this as the operational brain, the main Web3 backbone. Why ETH? There's lots of competition now, faster chains. Why is it still so central?
It really comes down to the network effect. It's just entrenched. ETH powers most of DeFi, decentralized finance, the whole NFT craze,
Right.
mostly on Ethereum. And the really big one everyone's talking about, tokenizing real-world assets, RWAs.
RWAs, right. We'll get into that.
Yeah, ETH is where most of that action is happening or expected to happen.
Yeah.
Has the developers, the security track record, the stuff institutions actually care about when real value's involved.
Okay, so network effect is huge, but what are the other drivers? Like Bitcoin, there's ETF talk for Ethereum too. How big a deal would that be?
Potentially massive, but it's a bit more complicated than Bitcoin's ETF.
Why is that?
Well, Bitcoin is pretty clearly seen as like a commodity, digital gold. Ethereum, because you can stake it and earn yield, and because fees get burned, it looks a bit more like an interest-bearing asset or maybe a productive commodity. That makes the SEC's job trickier in classifying it for an ETF.
Okay.
But if it gets approved, wow, it basically gives ETH the institutional stamp of approval as a regulated investment. Opens the door to a whole new wave of buyers who couldn't or wouldn't touch it before.
Beyond the ETF buzz, the tick itself has to keep up, right? The sources mention things like dank sharding, layer
Yeah.
2 rollups. Can we break those down? What do they actually do for ETH?
Yeah, super important. Ethereum's big historical problem was congestion. Like a busy city highway at rush hour, slow and expensive tolls, or gas fees.
Right, I remember those crazy fees.
Exactly. So dank sharding. Think of it less like widening the main highway and more like adding a whole bunch of parallel side roads, all synchronized, that can handle way more data traffic smoothly.
Okay, more capacity.
Tons more capacity. And layer twos, like Arbitrum or Optimism, they're like express lanes. They take a bunch of transactions, process them off the main highway quickly and cheaply, and then just post a summary back to the main Ethereum chain for security.
So faster and cheaper.
Much faster, much cheaper.
Yeah.
These upgrades are crucial for making Ethereum ready for like global scale usage, the kind of throughput institutions need. It just wasn't possible back in the last cycle.
And that brings us to what the analysis calls the megatrend, RWA tokenization. Real-world assets. This seems to be the core growth story for ETH. What kind of assets are we talking about?
Potentially everything. Treasury bills, company bonds, real estate deeds, maybe even art, intellectual property. But the sources focus heavily on the financial stuff first.
And why is Ethereum the go-to place to put these things on-chain?
Security, mostly, and trust. If you're a huge asset manager tokenizing, say, $1 billion of bonds, you need absolute certainty about the security of the underlying blockchain. Ethereum's got the longest track record, the most eyes scrutinizing it, the biggest developer community. It's seen as the most credibly neutral and secure settlement layer.
So the argument is, if ETH becomes the main place where these trillions of dollars of tokenized assets live and get settled,
Then demand for ETH itself just goes through the roof. Because you need ETH to pay the transaction fees, the gas, for every single transaction involving those assets. It creates this immense constant demand pressure.
and this isn't just theory, right? We're seeing big names get involved.
Absolutely. The sources make a big deal of Larry Fink, the CEO of BlackRock, biggest asset manager in the world, openly talking about tokenization as the future of financial markets. That's not just idle chat. That's a massive validation of the whole concept. And Ethereum is basically the main infrastructure for it right now. Plus, you've got JPMorgan, their Onyx division. already using an Ethereum-based network. Okay, it's a private one, but still based on the tech for real-world stuff like cross-border payments. They're not just testing, they're using it. That shows deep trust.
Okay, strong validation. Let's flip to the supply side. The sources talk about EIP 1559 and staking growth. How do those mechanics affect the price?
Right, this is a really powerful dynamic. EIP 1559 was that upgrade back in 2021 that changed how fees work. Now, a portion of every transaction fee gets burned, permanently destroyed, removed from supply.
So when the network is busy,
More ETH gets burned. It can actually make ETH deflationary sometimes, meaning more is destroyed than created. And at the same time, you have staking. Huge amounts of ETH are being locked up by people wanting to earn yield and secure the network.
locked up means it can't be sold easily.
Exactly. It's off the market. So you combine this potentially decreasing supply from burning with a massive amount of supply being locked away in staking,
Right.
while demand from DeFi and potentially institutions is rising. That's a classic supply squeeze. You can track these metrics, see it happening. It's a fundamental bullish factor baked into the code.
Okay, moving on. We've got the institutional bedrock with BTC, the institutional backbone with ETH. Pillar 3 takes us somewhere different. Solana, SOL. The sources call this one the retail speed demon, the high beta play.
Yeah, that framing fits really well. Solana was built from the ground up for one thing, speed.
Yep.
Massive transaction throughput, thousands per second, often for like fractions of a penny per transaction.
Which makes it good for.
Things where you need instant results and can't afford high fees. Think fast-paced DeFi trading, blockchain gaming where every action is an on-chain transaction, social media apps, maybe even those meme coins everyone talks about. Stuff that needs scale and responsiveness now.
And that term high beta, what does that actually mean for someone listening, thinking about risk?
High beta just means it tends to move more than the overall market, or more than the big guys like Bitcoin and Ethereum. So if the market's going up, Solana is expected to go up faster percentage-wise.
That's flip side.
The flip side is if the market tanks, Solana likely tanks harder too. It's more volatile.
Yeah.
The speed, the lower market cap compared to BTC, it gives it that leverage for potentially bigger gains, but definitely comes with higher risk.
Got it. So what's the proof? Where's the evidence that people are actually using Solana for all this stuff?
Well, you just look at the on-chain data. Solana frequently beats Ethereum in terms of daily active users, and transaction counts, often way higher.
Really? More users than Ethereum some days.
Yeah, it's a clear sign of where a lot of the high-volume, everyday retail activity is happening. Users, especially new ones, they don't want to wait or pay $5 for a transaction. They go where it's fast and cheap. And right now, that's often Solana.
And the sources point to one specific catalyst that really brought Solana into the mainstream consciousness recently. The meme coin explosion in 2024. BONK, WIF, those dog and cat coins.
Right, Poopy too.
Why are memes actually important here? They seem kind of silly for an investment thesis.
They might seem silly, but in terms of driving adoption, they were incredibly effective. Think of them as supercharged onboarding tools.
How so?
That whole craze brought millions, literally millions of new, often non-technical users into the Solana ecosystem practically overnight. They created wallets, traded tokens, interacted with DeFi, and the key thing, the network handled it.
It didn't crash or get super expensive.
Mostly, no. Fees stayed low, transactions went through fast, even under that intense, sudden load. That was a massive stress test, and it proved Solana's technical chops to the mass market in a way that abstract tech specs never could. It showed it worked at scale.
Okay, that makes sense. But it's not just memes and retail anymore, is it? The story seems to be getting more serious. Institutions are sniffing around. VanEck filed for a Solana ETF.
Yeah, that filing by VanEck is a big signal. You don't see major asset managers doing that unless they think an asset has reached a certain level of legitimacy, scale, and, importantly, future potential. They're basically betting that Solana isn't just a fad. It's a real contender as a high-speed financial layer.
And maybe the strongest validation comes from outside crypto entirely. Visa. What's the deal with the Visa pilot program?
This is huge. Visa, global payments giant, started using the Solana network directly to settle stablecoin transactions.
Like moving digital dollars around?
Exactly. Moving USDC, a major stablecoin, between different parties in their payment network like merchants and issuers internationally. They needed something super fast, super cheap, and reliable for a high volume. They picked Solana.
Wow. That's not crypto speculation. That's core financial plumbing.
Precisely. It's massive enterprise validation. It shows a giant, like Visa trusts Solana's tech for actual real-world high-frequency payment operations. That carries a lot of weight.
So lots of activity, both retail and enterprise. How should someone connect that usage back to Solana's price or valuation? How do you track if the growth is real?
The sources really emphasize looking at the correlation. Track the price of SOL alongside the actual network activity specifically, things like the total fees being paid on the network and the number of active wallets transacting.
And what should you look for?
You want to see them moving together, especially since late 2023 when things started picking up again. If the price is rising and the network fees are rising and active users are rising, that suggests the growth is organic. It's driven by real use, real demand for the network, not just hot air or speculation. That underlying utility is why Solana makes the list as a key pillar.
Okay, pillar 4. We've got digital money, BTC, smart contracts, and retail speed, SOL. But none of these blockchains can really talk to the outside world on their own, right? That's where Chainlink, Link, comes in. The sources call it the universal data bridge.
Yeah, essential infrastructure is probably the best way to think about Link. For anyone listening, an oracle, which is what Chainlink provides, is basically a secure messenger
A messenger for what?
for bringing reliable real-world data onto the blockchain. Things like, what's the current price of Tesla stock? What's the interest rate set by the Fed? Did the Lakers win last night? What's the temperature in London? Blockchains can't know this stuff on their own.
They're kind of sealed off.
Exactly. Without oracles like Chainlink, smart contracts are deaf and blind to anything happening outside their own network. Chainlink is the bridge that lets them react to the real world in a trustworthy way.
And this makes it absolutely critical for that RWA tokenization trend we talked about with Ethereum, doesn't it?
Indispensable. Think about it. If you tokenize $1 billion worth of, say, real estate on Ethereum, the smart contract managing that needs to know the current accurate market value of that real estate all the time. And it needs that data from a source that can't be easily manipulated.
Needs to be tamper-proof.
Absolutely. For compliance, for risk management, institutions need verifiable, reliable, decentralized data feeds. Chainlink has become the industry standard for providing exactly that. It's about security and trust for high-value assets.
And this necessity has led to some pretty big partnerships, according to the sources.
Oh, yeah. The list is impressive. We're talking Swift, the network that connects basically all the world's banks. Google Cloud is using them for data. Tons of major banks are involved in pilots or direct integrations.
These aren't small startups playing around.
Not at all. These are the core players in global finance and big tech, embedding Chainlink into how they think about connecting with blockchain technology.
And a big part of Chainlink's strategy seems to be this thing called CCIP, Cross-Chain Interoperability Protocol. What is that, and why do banks need to talk across different blockchains?
Right. CCIP is basically Chainlink's attempt to create a universal standard for communication between different blockchains and even between blockchains and traditional bank systems.
Like a universal translator.
Kind of, yeah. But for both data and value. Think about it. A big bank might use a private, permissioned blockchain for some things, maybe use a public chain like Ethereum for something else, and still rely on their old legacy systems. CCIP aims to let them securely move messages and assets between all these different environments seamlessly.
Okay, so it connects the islands.
Exactly. It's building the bridges needed for a future where different types of networks, public and private, all need to interact securely. It's foundational plumbing for institutional DeFi.
And we have concrete proof of this being used, right? The Swift pilot program.
Yeah, that Swift pilot was a landmark. They used Chainlink's CCIP specifically to test connecting different central bank digital currencies, or CBDCs, with existing private blockchain payment systems used by banks.
What was the goal?
Swift wanted to show their existing network could act as a central point connecting all these new digital currency initiatives. And they needed Chainlink to be the secure bridge between their system and the various blockchains. It was a massive validation, the core of global interbank messaging formally integrating with decentralized oracle tech.
So, the big picture. LINK isn't just for crypto nerds. It's becoming essential plumbing for institutional finance. How should someone think about its value or analyze it?
The analysis suggests looking for an adoption lag. Infrastructure plays like Chainlink often see their tech get integrated before the token price fully reflects that value.
So adoption comes first, price follows later.
Often, yeah. So the advice is track the number of Chainlink integrations.
Yeah.
How many major banks, DeFi protocols, and enterprises are actively using their services. Watch that number grow over time.
And compare that to the price.
Right. The theory is, as these fundamental adoption metrics climb, especially with big names like Swift involved, it builds up this immense potential energy. Even if the Linkage token price doesn't react immediately, that deep integration suggests a major price catch-up is likely, probably during the peak excitement phase of the 2025-2026 cycle. The value accrual is happening under the surface.
All right, Pillar 5. We've covered the giants, the established players. Now we get to SUI, S-U-I. The sources label this one the innovation frontier, the dark horse. It's a newer Layer 1 blockchain. What makes SUI special enough to be considered a pillar alongside BTC and ETH?
SUI's whole reason for existing is to push the boundaries on scalability and, maybe more importantly, user experience. It's designed specifically to handle the kinds of demanding applications that older blockchains struggle with. Think complex, high-fidelity on-chain games, AI applications, things that need instant feedback. Yeah, they talk about instant finality. Transactions aren't just fast, they're confirmed immediately, which feels much more like using a regular web application. That's crucial for making crypto feel less clunky for mainstream users.
Okay, so speed and usability. But the sources also mention this narrative building around SUI as a potential Solana killer. Is that just marketing hype, or is there some technical substance there?
Well, the killer label is always punchy marketing, right? Grabs attention. But there is a technical argument behind it. SUI's main differentiator is its programming language, called Move.
Move. Never heard of it.
It came out of Facebook's abandoned DM blockchain project. The engineers who built Move designed it specifically for handling digital assets very safely and critically for something called parallel processing.
Parallel processing.
Yeah.
Sounds complicated. Can you simplify that?
Sure. Think of most blockchains like a single-lane road.
Mm-hmm.
Every car transaction has to go through one after another. If one car is slow, everyone behind it gets stuck.
The bottleneck effect.
Exactly. Move allows SUI to work more like a multi-lane highway. If transactions aren't trying to touch the same piece of data, SUI can process them at the same time, in parallel.
So multiple toll booths open at once.
That's a great analogy. This parallel execution lets SUI handle way more transactions overall and makes building complex safe applications potentially easier and faster. It's a fundamental architectural difference from older chains like Ethereum or even Solana to some extent.
And is this technical edge actually attracting people? Are we seeing growth?
The numbers suggest yes. The sources point to really rapid growth in key areas. People are excited about NFTs, AI projects building on SUI, some unique DeFi applications.
Any hard metrics?
The big one mentioned is total value locked, or TVL basically, how much money is deposited in SUI smart contracts. Apparently that jumped something like 500% just in the second quarter of 2024.
500% in 1 quarter. That's huge.
Yeah, that kind of growth signals serious capital and user inflow. It shows growing confidence that the tech works, and there are opportunities there.
And developers, are they building on SUI?
That's another key indicator the sources track. They mention seeing noticeable developer migration from other chains, like Aptos, which also uses Move, and even Binance Smart Chain, over to SUI.
Why do developers move?
They go where the tech feels better, faster, safer, or where they see more opportunity. Developer momentum is often a leading indicator of where the next wave of innovation might happen. Talent follows promising tech.
And for any new chain, getting listed on major exchanges is crucial, right? For liquidity?
Absolutely essential. The sources highlight that SUI got listed relatively early on, the big ones. Binance, Coinbase. That gives it global visibility, makes it easy for people to buy, and provides the necessary liquidity for price discovery when the market eventually gets excited.
So the sources suggest comparing SUI's current growth path TVL users, developers, to Solana's early days, back in 2021 before it really took off. What's the point of that comparison?
It's about visualizing the potential velocity of growth. Solana exploded in 2021, partly because it offered speed and low fees when Ethereum was clogged. The argument is, if SUI's tech truly is a step up, especially for things like gaming, which could bring in millions of users.
Then it could potentially follow a similar explosive growth curve.
Or maybe even steeper. If it captures that next big wave of users coming in for gaming or AI-driven apps, the potential upside during a full-blown bull run could be immense. That's why it's the dark horse. Highest risk among the 5 for sure, but maybe also the highest potential reward if its tech lives up to the promise.
Okay, wow. We've covered a lot of ground. Bitcoin, Ethereum, Solana, Chainlink, SUI. Let's try to tie it all together. Why these 5? How do they create a complete picture for this next cycle?
It really is about covering all the bases, structurally. The portfolio design, if you want to call it that, hits every key layer needed for both institutions and consumers.
Okay, lay it out.
1, Bitcoin. That's your institutional trust layer, the base money. Digital gold, secure foundation.
Got it. 2.
Ethereum. That's the established infrastructure. the backbone for high-value stuff like DeFi and, crucially, that RWA tokenization megatrend. Institutional settlement layer.
3.
Solana. That's your speed and scale for the masses. Retail accessibility. High-frequency trading, gaming, consumer apps, low fees, high throughput.
Yep.
Chainlink. The essential connector, the data bridge. Makes everything interoperable, connects blockchains to real-world data securely. Critical for RWAs and institutional trust.
And 5, the new kid.
SUI. That's the cutting edge. The innovation play, focused on next-gen scalability, user experience, pushing the boundaries for future applications like advanced gaming and AI.
So it's like Bitcoin is the vault, Ethereum is the bank's main processing system, Solana is the high-speed retail payment network, Chainlink provides all the market data feeds, and SUI is the R&D lab building the next generation of applications.
That's a pretty good analogy, yeah. It covers the secure store of value, the high-value settlement, the mass market interaction, the essential data, and the future innovation. You kind of need all those functions for a healthy, growing ecosystem.
And crucially, the sources back this up with real-world examples, right? This isn't just theory.
Exactly. The validation's already happening. Look at BlackRock. Their Bitcoin ETF wasn't just a success. It was a statement. It signals institutions are here and they're not leaving. That validates Pillar 1.
What else?
PayPal, launching their stablecoin, PYUSD, on Ethereum. That's a massive consumer payment company choosing ETH as the backbone for their digital dollar. Huge validation for Pillar 2.
And Solana.
Visa, using Solana for stablecoin settlement. Again, a global payment giant trusting Solana's speed and cost for their actual operations. Validates Pillar 3.
Chainlink.
That SWIFT partnership. The core of global banking communications actively testing and using Chainlink to connect to the new world of blockchains. Massive validation for Pillar 4.
So the underlying stories for these pillars aren't just wishful thinking, they're grounded in things actually happening now.
Precisely. These aren't just crypto projects anymore. They're becoming integrated pieces of the next generation of finance and the internet.
So for you, the listener, trying to make sense of this complex space, the takeaway isn't just buy these 5 coins. It's about understanding the roles they play, the categories they represent. What tools did the research suggest for tracking how this whole cycle is playing out?
Yeah, they gave some clear metrics to watch. First off, dominance charts. Keep an eye on Bitcoin dominance versus Ethereum dominance versus Solana dominance.
What does that tell you?
Generally, Bitcoin dominance rising early often signals institutions are accumulating quietly. Then maybe ETH dominance rises as DeFi and RWA narratives heat up. Later, Solana or other altcoin dominance spiking can signal peak retail excitement and maybe froth. It shows where the money is flowing relative to the others.
Okay, dominance. What else?
On-chain activity, you have to look under the hood. Are active wallets actually increasing on these networks? Is transaction volume growing? Is the total value locked, TVL, in their DeFi ecosystems rising?
So are people actually using them?
Exactly. That separates real utility growth from just price speculation. You want to see the usage metrics climbing alongside the price.
And finally, sentiment. How do you gauge what the crowd is thinking?
The simple tool mentioned is Google Trends. Just track search interest for key terms. Bitcoin ETF, Ethereum staking, Solana price, SUI gaming, whatever it is.
Spikes mean more interest.
Big spikes in search volume often show when new retail interest is flooding in. It's a pretty good, though lagging, indicator of market sentiment heating up or cooling down. Using dominance, on-chain data, and sentiment together gives you a much clearer picture of the market's health. #CAG outro. Look, we've laid out the map based on the research, but everyone's journey through this landscape is going to be different. It really boils down to your own view, your own tolerance for risk. So for you listening, here's something to chew on, pulling directly from the kinds of questions these sources pose. Fast forward to, say, 2026. Markets potentially peaking. Where would you rather have put your focus? Would you lean towards Bitcoin? You know, the relative safety, the institutional backing, capturing those foundational gains, or would you have aimed for something like SUI, accepting way more risk, more unknowns for that shot at potentially explosive, maybe 50x type returns? It's the classic risk-reward question.
Or think about the platform battle. Ethereum versus Solana. Which one do you think truly wins the next cycle in terms of actual usage? Will it be Ethereum locking in the institutions with tokenization and DeFi? Or Solana capturing the masses with speed, low fees, and maybe that next killer app or game?
Yeah, where do you see the most activity landing? The sources make compelling cases for both the established giants and the disruptive newcomers. There isn't one single right answer. It depends on your thesis.
Absolutely. Well, that brings us to the end of this deep dive into the 5 crypto pillars analysts are watching for the next bull run. Putting together this kind of analysis, digging through all the source material from researchers, analysts, content creators in this space, it takes a lot of work.
It really does.
Yeah.
And we notice something consistent across the sources, especially those creating video or online content, like the channels providing this kind of research.
What's that?
How much they emphasize audience engagement. It sounds cliche sometimes, but for them, it's apparently the lifeblood.
Right. The sources explicitly mention this, things like hitting like, subscribing, commenting, ringing the notification bell. It's not just for vanity metrics.
No, apparently it directly helps their content get seen by more people through the algorithms. It boosts visibility.
And that visibility is what allows them to keep dedicating resources to doing the deep research, putting out quality analysis, and basically funding the kind of work that feeds into discussions like the one we're having today.
Exactly. So that engagement, that support from the audience, it's presented as genuinely vital for sustaining the flow of this kind of in-depth crypto information and analysis. Something to keep in mind when you find content you value.
Definitely food for thought. A huge thank you for joining us on this exploration today. We hope this framework helps you navigate the road ahead.
Yeah, take these ideas, dig deeper, form your own conclusions.
Until next time, stay curious and stay informed.